Okay, so there's only two different kinds of accounts, but we could add sub-accounts along the way that are going to give us a little bit more detail. So the baseline, we could call this like a single step income statement where we just have like income and then we have expenses, the two categories. But we could add more subtotals along the way, such as a cost of goods sold category and so on and so forth. All right, let's open up the income statement and look at this line by line. Remembering, as we do, if I go to this first tab over here and we go down to the sales tab and then into, actually, no, let's go to the transactions and then let's look at the chart of the accounts. So chart of accounts, when we set up new accounts, then that's going to be the ground basis on which we construct the financial statements. Down here, it's in order: assets, liabilities, equity, balance sheet on top of the income statement. Here are our income statement line items here that have the account type of an income statement. And then basically our expenses are going to be below that. Now, also just note, when we're constructing the income statement, it depends on the type of industry that we are in terms of how we're going to set up the income statement, in particular, also how we're going to have the bank feeds fit into the income statement, as we'll discuss more when we start to do our practice problem. But in general, on the income statement, you might have to deviate from a complete cash-based system if you're in the type of industry where you have to bill people, right? You got to send out invoices. That means that you're going to recognize the revenue when the invoice comes out, which means you recognize the revenue before you actually receive the cash, which makes sense from a performance statement or standpoint, because that's when you actually did the work. So you should recognize the revenue when you did the work, is the general idea. Now, a couple things on the income statement. We do not want to set up too many income accounts because it's too much detail typically on the income statement. So two errors that we want to be careful of. One, we don't want to set up a separate income account for every customer usually, because that means we're going to have a whole bunch of income accounts by customer. That's going to be somewhat tedious, too long, too cumbersome on the income statement, number one. And number two, hopefully, if we use the proper forms and add customers, like the invoice form and sales receipt form, as opposed to the deposit form, then we should be able to generate a subledger report that's going to tie out to total income broken out by customer. So I can get the more detail in another report, and therefore I don't want it on the profit and loss because it'll be too tedious. However, there are exceptions. If you're in a very simple system and you're building your income statement by the bank feeds, maybe you're just a gig worker, all right? I'm not like putting you down. I basically a gig worker, right? But I mean, like, it's a simple accounting process, right? If you get paid by like Google or platforms or something, then you're just going to wait till it clears the bank and record the deposit as income. In which case, you're not going to record the customers most likely, and you're getting paid by the platform. So therefore you might set up your income accounts called whatever the platform income, basically by customer. But that's the exception to the rule, right? If I was a landscaper or something like that, or I sold inventory, I'm not going to make another income account for each customer I sell to. The other thing that we want to be careful of is not making a separate income account for every thing that we sell, every inventory item or service item, because once again, it'll get really tedious. You'll end up with this long income statement. And normally, if you use sales forms and invoices, you should be able to get that added detail by running subledger accounts, tying out to the income, but breaking out by the things that you're selling or services that you're selling, inventory and service items. So this income statement actually has more income accounts than you would expect from most businesses, because the type of industry it has, being a job cost kind of system, basically landscaping. So just keep that in mind. You possibly have more income accounts here than you would generally have in most type of businesses, where you might just have one income account, even though the income line item hopefully will have a bigger dollar amount than the expense line items. It's usually a lot cleaner, or one line item versus multiple line items, for example. All right, so that's going to be the income statement. The income statement's going to go up, as we can see when we enter income forms. That's going to be the invoices if you have to deal with accounts receivable, or if not, the sales receipts if you're at a cash register, and if you have a very simple system and you're using the bank feeds to record it, you will have the deposit forms increasing the income. So they're going up.